We're half an hour from the open in Hong Kong, Shenzhen, and Shanghai. You're watching The China Show. I'm Avril Hong with David Ingles. Our top stories.
Yep, let's get their top stories today. Asian stocks surge after President Trump says he has no intention of firing Jay Powell. It only gets better from here. President also signaling he's willing to strike a deal that would make China, in his words, very happy. Now, the IMF slashing its global growth forecast to the lowest since the pandemic, citing the impact of U.S. tariffs that have risen to the highest in a century. Now, also just ahead here, Tesla shares jump as Elon Musk says he'll soon pull back from DOGE to focus more on the company that's dealing with its worst sales slump in years.
And I'm Stephen Engle inside the Shanghai Auto Show, day one of the press day. Lots to talk about. Obviously, Trump's tariffs will be on the minds of many of the participants here in the many halls of Shanghai Auto Show. We're speaking to a number of executives from Geely to Pony.ai and others to discuss their global expansion plans for their EVs, like this one right here. This is the Zeekr 007 GT. We need to hear their strategies in the face of a trade war as they expand beyond China.
Good morning. Welcome to the China Show. Just to borrow something that Steve just mentioned there, 007. Bond. It's everything but bonds today. As you can see, equities are bid. You have the dollar also catching a very strong rebound over 2 days. We are extending the bounce that we had from overnight into where we are right now. It's worth pointing out that 48 hours back, a lot of the dollar trades did seem extended as far as the overbought levels were concerned. So you are getting, of course, quite a hefty pullback in the euro. You have the yen, of course, also seeing a bit of weakness right now. Dollar Swiss, yes, you can see half 1%. So we're not normally seeing this type of moves across price. Now, as far as Asian equities are concerned, as you can see, a hefty move to the upside across just about everything right now. Everything from the Nikkei, a couple of markets opening up. Right now, you have Taiwan. That's really leading to a 1% gains right now on the index itself. Right, so we are seeing a pullback on the dollar trades. We are also seeing a pullback in gold. That's coming up on your screens very shortly from June all the way down through October after we hit 3,500 yesterday. So we're off by about 38 right now. We were off substantially as well overnight. So we're looking at gold-related stocks as well as we approach the open today. Also looking at e-commerce related stocks, big tech, massive move up overnight. In fact, we were up as much as over 4% at one point on the Golden Dragon Index. Just a look really at everything, a cross-section from Meituan, Baba, JD.com, though going the opposite way. BYD was up 7% in the overnight session. Right. Now, conversations around de-escalation, whether that's, Trump on Powell, Trump, Besant, White House on China, again, leading to the bounce in the dollar. And we're not really seeing that play out, though, as far as, quite clearly, as far as the dollar-China trade is concerned, because you are also getting, to some extent, some weakness coming through in the currency because of the dollar pivot that we've had overnight. In other words, masking what would have otherwise been Avril, quite clear dollar China to the downside right now. We'll see what the fix looks like today. Avril.
Yeah, on that note, on Trump, on Powell, the U.S. president saying he has no intention of firing the Fed Chair, Jerome Powell, and that's despite his frustration with the central bank not moving faster to cut interest rates. The president had lashed out against Powell last week, posting online that his termination could not come fast enough.
The only thing that hasn't come down but hasn't gone up much are interest rates, and we think the Fed should lower the rate. We think that it's a perfect time to lower the rate, and would like to see our chairman be early or on time as opposed to late. Late's not good.
Mr. President,
I don't want to talk about that because I have no intention of firing him.
Now, the president also signaling that the U.S. will be making a deal with China. Keep in mind, right, 145%, that's the current tariff. He says that the final figure will be much lower than the current level. Let's bring in Min Lo, our China correspondent, here with us to talk us through, Donald Trump, the comments there. He's pulling back from the brink, signaling perhaps a detente there. he's going to play nice, he says, with Beijing.
Yes, so reporters were asking him, is he going to play hardball with China? And he said no. Quite an interesting change in his tone here. He says those final tariff levels are going to come quite significantly down, although it's not going to be zero. He says China has to make a deal. If they don't make a deal, the U.S. will set the deal. So certainly that window for potentially making a deal with China is just cracking open slightly wider. This comes as Treasury Secretary Scott Bessent also said in a closed-door investor summit hosted by JP Morgan Chase, saying that this standoff is no longer sustainable and both sides will have to find a way to de-escalate, he said, at a very near future. Although he says any sort of very big, comprehensive trade deal will still take some time to materialize, perhaps 2 to 3 years. But of course, we have seen how President Trump sometimes eats his own words with the comment on Jay Powell there. So sometimes it's really hard to discern, is this just a throwaway comment to shore up markets, or is it really a shift in his stance towards China?
It's really difficult to believe, given just the 180-degree turns we get almost on a daily basis here. But yeah, but how then is China expected to react? And also, do they give a lot of their cards away right now, not knowing, of course, what the U.S. president says? Yeah,
of course, because President Trump has been so mercurial. It will be interesting to see how China will react today. And I mean, if you were China, this is a good opportunity to take that opening, that softening of the stance from Trump to maybe reach out to them. But of course, the question is, what can the U.S. offer to China that would make them be open to signing a deal? Because so far, China has said that they are going to fight till the end, although they are open for dialogue. If the U.S. is willing to speak to them as an equal partner, they have laid out certain preconditions, especially wanting the U.S. to ensure that they don't view China as this strategic rival, which, I mean, to be honest, the starting point for these two countries are just so far apart. It's really hard to say what that deal would look like.
Yeah, and interesting to see whether this is ultimately a softening of tone, if at all. Our China correspondent Min Min Lo in Hong Kong for us there. And up next, we'll be speaking with Allianz global investors about whether the latest White House signals on trade and the Fed can sustainably shift market sentiment. And we're counting down to the open of trade in Shanghai, Shenzhen, and Hong Kong. This is The China Show.
If we have this cloud of uncertainty coming lower and lower, making it difficult for the business community and for households to take decisions, we could have a self-inflicted injury that I guarantee you we would regret.
Kristalina Georgieva there, IMF MD, speaking with Bloomberg at the fund's annual spring meetings, of course, taking place in Washington. They've taken their growth forecast down to 2.8%. A lot of developments overnight. That's number one. Number two is you had Scott Bessent. Our reporting suggests that they are signaling quite a pullback from the edge, de-escalation. A deal is possible, he says, with Beijing. Donald Trump, of course, also signaling the same. And also, separately, on a fairly also relevant story, they're also pulling back as far as he says he has no plans on firing the Fed Chair Jay Powell. Markets, as you can see, with the exception of U.S. Treasuries, largely, are reacting quite well to positive developments overnight. How much can we believe the price action and the commentary, given it changes almost on a daily basis? Jenny Zeng is here with us, Deputy Head of Fixed Income and APAC Fixed Income CIO at Allianz Global Investors. Good morning. The question I keep getting, I don't have an answer to it clearly, I'm not sure if you do, is can I still trust the risk-free nature of U.S. Treasuries?
That's a great question. It's a $1 million question as well. But let's get started. Let's take a step back and look at what actually happened, right? We see that this is the first time we've seen this happen in the U.S., which has enjoyed a very unique status in the capital market. But what we've seen since the beginning, since the Liberation Day, pretty much that, we've seen equities down, we've seen U.S. Treasuries selling off, we've seen weaker dollar as well. This usually, you only see this with emerging market. But this is a time that we see in the U.S., the most sophisticated, mature capital market in the world. Now, why that's the case? And usually when risky assets are selling off, U.S. Treasuries are acting as a safe haven assets, as anti-fragile assets. But why not this time? I do think there are a few reasons behind that. And inflation expectations are going up because of the tariffs. And people are still worried about the supply. There are supply concerns. And also people are asking for a little bit risk premium given all the uncertainties that other assets are talking about. But most importantly, particularly in the short term, I think the key drivers is flows. If you look at fund flows or since the beginning, since the Liberation Day, you can see there's massive, very rapid, massive outflows from the U.S., from U.S. Treasury, including in U.S. Treasury as well. So I do think that is people are voting by feet, saying, okay, now let's recess the status of the U.S. and, and let's diversify first. Let's exit first and think about it, yeah? And then before we make the next decisions.
Yeah, and, the step to that move usually was to get it in short-term dollar cash. So what's plan B, though? So we've answered half of the question. What's the alternative?
Well, the thing is, if you think about a safe haven assets, mathematically so far there's not a very significant statistic showing anything else that's a safe haven assets. Yen did well. Yeah. The yen did well, and it used to be a safe haven assets. So maybe, and in fact, and if you look at some other currencies, they've done okay. But from a longer-term perspective, we haven't established something that's very strong statistically to show that they can replace the dollar as a safe haven assets. Gold, obviously, has been doing really, really well. And mathematically, that's what you can actually have to show that this is an anti-fragile assets. That's perhaps the only anti-fragile assets at the moment. Now, so when people are exiting the U.S. market, so it's anonymous. Sorry, it's indiscriminate. Yep. So they exit everything from the U.S. so that they're diversifying into other markets as well. So interestingly, U.S. still enjoy this exceptionalism in some ways, because if you look at it from Liberation Day to now, pretty much only the U.S. and plus some LATAM countries, the yields are going up. European yields are going down. Most of Asian countries' yields are going down. So you can see that people are diversifying from the U.S. to the rest of the world, pretty much that.
Jenny, Avril in Singapore here. I mean, to your point about not really having alternatives, it's also against this backdrop of the U.S. president in the past month kind of having a market put not just on trade policy, but also on his comments on the Fed. Are some of these cracks or the damage to the confidence from investors more permanent, more sinister here?
That's a great question, too. Now, I do think this is part of the reassessment that investors are having on the U.S. assets. Everything that's happening in the political landscape in the U.S. has prompted investors, particularly foreign investors, to reassess what should be the risk premium of U.S. assets, particularly the U.S., the more safe haven U.S. assets like U.S. Treasury, like U.S. dollar. I do think, given that Trump apparently is changing his mind almost on a daily basis, the issue is the range of outcome currently is so wide, and nobody can pin down any particular outcome to have predictability of that. Right? So I think overall, people are asking for a high risk premium on all U.S. assets. Back to
Where
you.
does this leave China, Jenny?
Yes, China is in actually a very interesting place. Now, if we think about China, again, there's no winner in a trade war. Well, we can argue that China this time is better prepared, which China is, compared with the last round of trade war. China has diversified its trade partners significantly from the U.S. The difference between China or even the rest of the world, including Europe, versus the U.S. is, for the U.S., there are too much unknown. But in China, you can properly analyze what actually could be the impact. Now, why is this? If you think about the U.S., we can pretty much say that a combination of an inflationary supply shock because of the trade tariff and a potential weakening of demand is inevitable. But how these two react to each other, how they interact with each other, it's very unknown. But if you look at China and the rest of the world, the impact from the trade tariff is much more analyzable because it's mainly from the demand side. We can say, okay, China's exposure to the U.S. is 14-15%, whatever numbers that depends on different analytics. Now you can say, okay, worst case scenario, it's all gone. It goes down to zero. You have a 2% impact on the economy. At least from a policy perspective, that's your worst case scenario, and you know that this is what you need to do from a monetary and a fiscal policy perspective. So that's why, in fact, there are more analyzability to what the situations on China.
Yeah, I think we're used to quantifying the factors that affect everyone else but the U.S. certainly right now. And I think we were talking before the show started. You're not certain that the Fed might be able to move short term, but it's clear everyone else is moving lower on rates, if not tilting dovish. Is that a good indicator of how I sort of formulate fixed income strategy? It's almost everything but treasuries right now?
Fed is in a rock and hard place right now. I mean, as Jay Paul just recently said, that they're very committed to the due mandate that Congress gave them, which is full employment and price stability. Now, if we think about the tariff impact, it's very difficult to analyze, to predict what's going to happen on either side. So I do think the Fed needs time to see whether how much reflationary pressure there will be in the economy. And at the same time, because of the uncertainties that the tariffs brings on business, on consumers, right, how much hit you're going to have on employment in the end. So which one you act first? Which side of the equation that you're going to get into the decision making first? There are a lot of uncertainties here. Now, but if you look at the other parts of the world, the decision making is relatively easier. As China as an example, Malaysia recently is a very good example. It kind of has been behind the curve from a market expectation perspective, but that also because they have a lot of dry powder they can use, right? So that's why when they see, okay, I will see that the numbers are starting to get a bit weaker, but my inflation is well under control. Let's cut more than people expected, right? China will be the same thing. Now, China hasn't done much yet so far. It has been very measured. Why? Because recent data has been quite solid. But the data will come down. That's certainty, right? We will start to see the impact of the trade tariff on China's economic growth soon enough. Then that's when China will start to cut rates and they will start to have more physical spending, more expansionary physical spending for the economy. I think that is also should be a known unknown.
Okay, well, it's not all that uncertain to the point Jenny was making there, sifting between the noise there. Jenny Zeng, thank you so much, Deputy Head of Fixed Income in APAC, Fixed Income CIO at Allianz Global Investors. Just 10 minutes to the opening bell. We'll get you a preview of the trading day ahead, plus a lot of good conversations coming up from the Shanghai Auto Show. Futures are pointing to the upside this Wednesday. This is the China Show. Good morning.
The Shanghai Auto Show is getting underway with the Trump tariff war hanging over an industry already grappling with a slowdown in demand as it transitions to electric vehicles. Our chief North Asia correspondent, Stephen Engle, is there with our next guest. Steve.
All right, Avril, thanks so much. Yes, this is our first interview of Auto Shanghai 2025. We're at Zeekr, which is the luxury pure EV brand of Geely, one of the biggest automakers here in China. And we have with us Stefan Sielaff. He is the Zeekr Vice President of Design. So, good morning to you.
Good morning, Stephen.
So
hello, everybody.
You are the design guy, so you're not the tariff guru. So
exactly.
Right, but at the same time, it's at the backdrop of everything that every car maker has to consider right now. And you are expanding the brand overseas. So how do you balance everything to make the car not only appealing for the China market, but now for new markets that are maybe the unintended consequence of the trade war, you have to go to smaller markets that are not necessarily developed yet?
Exactly, Stephen. We are already active outside of China in 40 different markets by now. And the question always is, how do you do a global design? Not only to please our main customers in China, but also our customer globally. And I have to say, I have a team of around 400 people in Gothenburg, Sweden, and in Shanghai studio, 2 studios. Young team, very international, 35 different nationalities. And of course, we are automatically doing global design. And I have to say, the taste in between Chinese customer in the luxury segment and global customer outside of China gets very close together. So no issue.
Does something like this shooting brake style seems to be of the 007 GT, seems to be a real common theme among many car makers right now, to the point where some are criticizing they're all starting to look alike. But this probably translates around the world. But also later today, you're going to be unveiling, is it the X9?
9X.
9X.
Really, really big SUV, exactly.
Does something like that translate as well, or is that a pure China play?
No, I think it's going to translate as well in other markets. And what we do in Sika Design, and you know we just exist for around 4 years, and we started the whole brand identity and design identity from a white canvas, which is an advantage and a disadvantage, but we always were pushing for a very calm design language. You know, instead of 50 lines, one clear line, one clear body language, which makes sometimes things a bit more difficult, because we talked before, sometimes it's more difficult to do something simple than do something overcomplicated, but it resonates very well with our global customership.
Simple, but your new 9X super hybrid SUV, which is still under wraps over there, is quite bold.
Yes.
I mean, it is aggressive styling with very sort of a squarish design with steel, not steel, but steel grills in the front. Yeah. Very masculine.
Yeah. Well, it's the type of car, you know, it's a super big SUV. That's, of course, the king of the road, let's say. And I think that's expected by these luxury customers we are addressing, that you have a certain dominance. Yeah. And nevertheless, we did something very, I would say, clever. The chrome you will see today is not necessarily what you have to buy as a customer. You can have the same thing in body color, you have to have the same thing in a kind of tinted chrome, so we can play with the graduality of being a bit more or a bit less bling bling. Yeah. So, and that's good.
From a design and branding perspective, how important is it to basically join those brands like you've done with Lincoln Company, which was another Geely sub-brand from Sweden? Yeah. Does that help you take the brand overseas at a time when there is some, maybe negative perceptions?
Not so much. The funny thing is, in the Sweden studio where we are operating as a headquarter of design, we work already for 4 years together in the same building with Lincoln Co. colleagues and Sika colleagues. We share the studio. We share all the facilities, so we did the merger already a long time ago. Yeah. Good efficiencies, of course. Sometimes, capacity is high here, the other day it's high on the other side, so we can balance capacities. Design language-wise, we try to really keep it separate. And we drift more and more away from Lincoln Co., where we started 4 years ago, and really fight for having a very unique design identity for Sika, and also progressing on the Lincoln Co. side.
Now, on the branding side, obviously many of the car makers here have been, over the last years, touting their own intelligent cockpits. You yesterday at the Peace Hotel talked about the intelligent cockpit. Is it G-Pilot?
Yes, exactly.
And that's going to be unveiled first in the 9X
exactly.
super hybrid SUV. Do you have to sort of downplay that, though? Because we're seeing from the Chinese government, it's kind of taking a little bit more concern about calling it self-driving or autonomous driving because of the safety aspect?
I think it's a question of time. Like always, you know, the first-to-market technology normally needs a bit of time to curate and get a bit more mature. And this will happen, and it will become top of the top, because safety is our first and foremost item within Sika. So we will not deliver a car that is not safe in the end, just for doing something quick and dirty. And I think on long term, talking again a little bit more in this aspect about design, this is the future in the interior that's going to happen. You get more and more support. The car is going to be more a butler and giving you all the service. So a lot of the game is going to play in the future, even more than today in the interior.
Well, the Chinese customers, on average, I would say, than American, are asking and demanding the highest technology, are they not?
Of course, of course. They are dealing with this every day. You know, our phones, our computer, everything is getting more advanced, not maybe every day, but every few months. And this is, of course, also super important in the cars. As you know, you can't change the interior whatsoever every few months, but you can update with OTAs, and this is going to be the status quo in the future.
Stefan, Sielaff, thank you so much for having us here at the Zeekr booth. Good luck to you here on day one of the press day of the Shanghai Auto Show. Thanks so much. Okay, send it back to you for now. Plenty more coming from Shanghai.
Yeah, really looking forward to those upcoming conversations. Our chief North Asia correspondent Stephen Engle in Shanghai for us. And let's take a look at how markets are opening, because following on those comments from Trump, from Besson, there's a lot of optimism on US-China trade talks, but cross currents as well. So when you look at the likes of dollar China, maybe the picture not so clear in terms of the read-through, given how there is an element of the dollar slumping. But in terms of what we're seeing in the stock performance, that is a bounce that we're seeing on the mainland. Take a look at what we're seeing in Hong Kong as well, because if you take a closer look at the Hang Seng Tech, every single stock on that index is well in the green. And this is despite some of the competition that we're seeing feeding in from this really rivalry, the space, whether it's coming from e-commerce giants or these delivery firms. And against the backdrop of all this, of course, was also the handover that we got from Wall Street and the walk back that we got from the US president when it comes to targeting the Federal Reserve. These are the Tesla suppliers, because of course we also got earnings. But what was key to watch were Musk's comments that he's looking to limit his time at the government, even though he's not stepping down from DOGE. CATL, you're looking at the other Tesla suppliers in China rising today. To the board again, as I say, for Chinese tech names, it's really the element of competition. And David, I know you're going to be raking through all these moves from these tech giants, but just to give you an idea of what this has meant for price targets, amid the competition, we've seen the likes of Macquarie cutting to neutral both JD and Meituan. David.
Yeah, really, I guess it's a function of the catch-down move that we had. Well, as a catch-down to the move that we had, certainly yesterday, and quite a sizable move. But it's, you know, like news these days, it's almost a completely different universe when you look at what's taking place, in fact, right now. So, yeah, I mean, just to recap all of the different strands across the Chinese tech space, right? And I think it's important to, you know, when you take a step back, and I'm going to go through the details here, you take a step back, there are indications of perhaps less competition in some areas, and indication of more competition in others, right? So JD.com and Meituan and that sort of back and forth that they have on social media. Separately, though, and I think to indicate the former, is you have to do, like, you know, Alibaba and PDD halting these refunds with no returns, which is really I guess in many ways a practice that they have put in place to bolster the value of their own service. Let's get the take right now from Catherine Lim, our senior industry analyst from Bloomberg Intelligence, joining us out of Singapore today. Catherine, why don't we start with Baba and PDD there? And am I overthinking that? Might this be an indication that competition is becoming less fierce there, or is there a more idiosyncratic take on that?
Right. David, you know what? I never dared say that, you know, competition is less fierce in China, because it's always there. But the good news out of this development really is that it's going to make refunds in China less costly. And if we actually take a step back, that's really going to benefit the e-commerce companies and PDD in particular, because in this environment whereby they are defending and they are doing what they can to actually help support sellers on Temu, they are the most exposed, I would say, to the US tariff hikes versus Alibaba, versus Douyin, Kuaishou, even JD.com. And these cost savings is going to help PDD, as it actually goes out on the other side, helping sellers sells more outside of US in other markets. So I would say that this is a good development overall because the landscape in China is healthier. The e-commerce companies are saving monies and they can use those monies and help defend sellers in overseas markets.
That's a good point you raise, Kat, because I think you've also highlighted that this controversial refund policy was something that Pinduoduo itself started. But when it comes to overall competition, we're not just seeing it amongst the e-commerce names. I mean, particularly for food delivery, right? And we've seen JD quite recently an entrant in that space. Now it's trying to make headway. What do you think will move the needle as it tries to wrest market share from Meituan? We're seeing all these moves that both sides are taking.
Right. I hear you, Avril. And on the food delivery side of things, competition on that front is good for consumption. I'll put it this way. Yeah. So, it's going to fit in with what China is also trying to actually drive and support domestic consumption amidst, the macro headwinds. But of course, from a company's perspective, I would say that, we've actually see the second glitch from JD.com overnight. As, I think over lunchtime yesterday, there was a technical glitch and orders were just not being placed, seamlessly. They have jumped out. And now, in addition to waiving off delayed fees for delayed orders, they are now handing out cash coupons, to orders or customers who actually receive their orders 20 minutes later. Even to the extent of, cancelling their orders, they are out to actually retain the customers who have deflected from Meituan as well as, Ele.me. So overall, again, it will cost JD.com more. I think they are prepared to do that. Whether that's going to actually then take away some share and, Avril, I do think Meituan is still going to have a lead in the entire food delivery market in China. But, it's not going to be a big monopoly as it is. We're going to have to actually, share a little bit of that cake to the other e-commerce companies. And I think that is what, we need to be mindful about for Meituan. And there is enough in China for more companies to actually, gain and take part in this food delivery market.
Yeah, and Catherine, just as a final point there on Meituan, we understand based on this report out of Thailand that the company managed to get, if I'm not mistaken, approval, the first company to be able to offer drone delivery nationwide. Might that, I guess, to your point, over the short term, increase that temporary moat there for Meituan?
Right. When it comes to drones and then linking it to increasing social security for riders out there, it's a little contradicting as you think about it, right? Is it essentially going to help save costs? I think the key thing from the drone and from the efficiency of the delivery is that it's going to speed things up, which is a great thing, for customer experience. Except that, I think the dynamics of whereby we're trying to actually ensure that employment is still stable. In China, we're testing out drones, and maybe riders can actually make use of these drones to actually reach places that they're not able to get there within 20 minutes, right? So, there's a lot of combination in this. I do think that, from the looks of it, food delivery in China might actually offer us or the rest of the world some emerging trends that, we'll not expect and, the other markets may emulate.
Yeah, replicating some of these trends. Maybe we see drone delivery in the likes of Singapore as well. Catherine Lim, our senior industry analyst at Bloomberg Intelligence, live from the Lion City. We'll have more analysis on Meituan and JD.com coming up in the next hour on The China Show. Morningstar will be with us to look at how the dispute between the two firms could impact their margins and services.
Now back to the macro here. So the IMF has slashed its world growth forecast for this year and next, citing risks from this global trade war. Kristalina Georgieva, the managing director, also told Bloomberg that the chances of a global recession will rise if uncertainty over tariff policies drags on. She spoke to us on the sidelines of the IMF's annual spring meetings in Washington.
Trade is an engine for growth. And what we see these days is that when trade goes backwards or slows down, that has implications for global growth. As you know, we just projected the growth expectations for 2025. We are downgrading by 0.5 percentage point from 3.3 to 2.8%. Our forecast for the world, we are downgrading our forecast for almost all countries, including the United States, as a result of trade tensions.
Yeah, one thing that in that world economic outlook, you put the chance of recession in the United States up to about 40% from 27% back in January when you first published it. If the tariffs stay as they have been proposed from the United States, do you expect that chance to go up materially?
This is based on the announcements of tariffs that have been then suspended, but not for China. So it's a complicated story. The short answer is that we are operating at a time of very high uncertainty. If we see faster resolution of trade tensions, that would possibly lift up projections for global growth, great for investors, great for families. If, however, we do not succeed and uncertainty remains very high, tariff problems hang on our head for much longer, then we actually can see even further reduction in global growth, and then the danger of recession looms bigger. What is our advice? Please talk with each other, find a way to resolve differences, and above all, reduce uncertainty. Uncertainty is bad for business.
And I think a lot of people have raised that issue. There has been speculation, including by this administration, that the United States could potentially even withdraw from the IMF. Do you see that as likely or possible? Do you have contingency plans for that?
We have very good relations with the United States. We have traditionally worked very closely with each and every U.S. administration. We have now established relations with this administration. The United States is carrying out reviews of its participation in international organizations. This is very fair. They have the right as a member to look into the mirror and say, do we have value from participation at the IMF? And I can tell you, I'm convinced that they look at this and they say, yes. Why? First, we are the only institution that can rescue countries in trouble. There are many countries that the U.S. cares about, that the fund is there to help them in a moment of high trouble. Two, we are the only financial institution, Lisa, that is like a savings bank. The U.S. puts money, we lend, then we give it back to the U.S. with interest. The last 2 years, we have paid $3.1 billion in interest to the United States. So, you know, the concern is, are taxpayers of the United States paying? In the case of the fund, no. And three, we are promoting things that the U.S. cares deeply about. Private sector-led growth, discipline, transparency, accountability. And I think for all these reasons, and also let me not forget, where are we? We are sitting with you 2 blocks from the White House. I think that the outcome of this review for the IMF would be, yes, great institution, we stay.
IMF Managing Director Kristalina Georgieva speaking with Bloomberg's Lisa Abramovich in Washington. And here are some geopolitical stories we're following. A high-level Japanese delegation is set to deliver a letter from Prime Minister Shigeru Ishiba to Chinese President Xi Jinping. The gesture highlights Japan's desire to balance its relationships with China, its largest trading partner, and the U.S., its sole formal security ally. It also comes as Tokyo proceeds with tariff negotiations with the Trump administration. Prime Minister Narendra Modi has cut short his trip to Saudi Arabia after gunmen killed as many as 26 people in India's northern Jammu and Kashmir region. The Press Trust of India says the attackers opened fire on tourists and 2 foreigners were among those killed. U.S. Vice President J.D. Vance is currently visiting India and described the attack as horrific, while President Trump offered full support. And if you're a Bloomberg subscriber, you can catch up with all our interviews by using our interactive function TV Go. You can also join the conversation by sending instant messages to our team and our guests during our live shows. Check it out at TV Go. This is Bloomberg. You're watching The China Show, and here are some of the corporate stories we're following this morning. Regeneron has agreed to pay Fujifilm more than $3 billion over the next decade to help make its medicines in the U.S. Under the deal, Fujifilm will produce drugs for Regeneron at its facility in North Carolina, which is set to begin operations later this year. The move allows Regeneron to quickly increase its U.S. manufacturing capacity amid the threat of tariffs. Bloomberg has learned that a group of private lenders led by Apollo and Blackstone are providing a $4 billion loan to support Thoma Bravo's deal to buy Boeing assets. Sources say the 7-year financing will carry a rate of 4.75 percentage points above the benchmark. Boeing agreed to sell its flight navigation unit and other digital assets to Thoma Bravo for $10.6 billion.
Yeah, there's a lot of buying taking place across these markets right now. JD and Meituan and Alibaba really leading the gains, although that being said, it's quite noticeable that some of these things are coming off highs quite quickly. In fact, JD.com is almost back at the zero line right now. Alibaba, which was up as much as 6 at one point, now has a 4 handle to it. A couple of other movers, of course, gold futures are pulling back from 3,500 yesterday, as with, of course, some of the related equity plays across the region. Where you are getting a lot of buying, though, taking place amidst fairly light volumes is in the tech space. We have everything from NASDAQ futures. We'll talk about the Tesla story in a moment there. Taiwan is up 3.3%. HS Tech is up about 2%. So, yeah, just the right amount of butter today across these markets. We'll see how long this lasts. Avril.
Yeah, I mean, David, when it comes to tech, the other story that we've been following very closely is the struggling chip maker Intel. And Bloomberg has learned that Intel is poised to cut more than 20% of its workforce as the new CEO tries to bring back an engineering-driven culture. So for more on this, let's bring in our Asia tech reporter, Jane Lanny Lee. Jane, first off, 20%, if this comes to pass, is quite a sizable reduction. But what is actually the goal of a restructuring of this magnitude?
Right. It's hard to say if these cuts go deep enough. It is a huge chunk if it's announced at this level. But in comparison, NVIDIA, which doesn't have chip making facilities, they just design them. So they have about 31,000 employees. AMD has about 28,000 employees. Again, they only design chips. And TSMC, which is a contract manufacturer that makes the chips for these, other fabless, as we say, chip design houses, have about 76,000. So, Intel has design and it has the foundry business, which is its business for making chips for itself and for others. So, it does bring it under the level of a TSMC plus an NVIDIA example, but it remains to be seen if that will go deep enough, considering some of the difficulties Intel faces, especially with a lot of its sales dropping and challenges with new products, etc.
Okay, Jane, thank you so much for getting us up to speed. The company reports, I believe, on Thursday, so we'll see if they do manage to confirm that going into that. And certainly more interesting point there as well, as Jane was just underscoring there, is this simply trimming the fat back to this reversion to the mean that we see in the industry, or is this, again, a change of strategy? Or maybe a bit of both. Anyway, check that out, the story out, our scoop, of course, on the Bloomberg terminal. A brief look across these markets, and yeah, we are catching a substantial bit, extending the gains that we had. Overnight on Wall Street, U.S. futures are also pushing to the upside. It's a good day to be long these markets. This is the China Show.
You're watching the China Show. Let's take a look at cryptos as part of the reversal in Trump trade. Certainly, we've been seeing the biggest of these digital currencies, Bitcoin, initially earlier in the year, taking a bit of a stumble, but more recently, it's kind of risen along with gold. Let's bring in Bloomberg senior editor Ryan Weeks for a bit of analysis on this. So, Ryan, help us understand why Bitcoin is trading the way that it is.
Yeah, so Bitcoin has pushed back to above $90,000 again in recent days. It's behaving a little bit more like a haven asset amid volatility in wider markets triggered by the trade war. And, so I guess it's sort of decoupling from US stocks in a way that we haven't seen for a while. Inflows into US Bitcoin ETFs earlier this week were the most we've seen since January. The notion of Bitcoin as a kind of a haven asset is coming to the fore again, and that's been one big tailwind for Bitcoin. Another big factor just in the past few hours is that Tether, SoftBank, and Cantor Fitzgerald are reportedly in talks to set up a crypto accumulation vehicle, a special purpose acquisition vehicle. I guess not dissimilar to Michael Saylor's strategy. That's given crypto a boost as well. And then, the sort of the easing tensions around the trade war and around concerns around the Fed's independence, despite what I said earlier about Bitcoin potentially diverging somewhat from the Trump trade. Actually, that has also seemingly given Bitcoin and other cryptocurrencies a bit of a boost this morning.
And we'll see if it lasts. But yeah, certainly it's acted like a haven asset, almost at convenience some days, and it's almost like gold. And some days it's acting like a risk asset, like I guess in some ways today. Ryan, fantastic. Thank you so much. Ryan Weeks, our senior editor, getting us up to speed on the Bitcoin story and this massive rally back above 90,000. CSI 300, a tenth of 1% to the upside. The second hour of the China Show is just ahead. Welcome back. You're watching the China Show. Just half an hour into the cash market session in Hong Kong and up in mainland China. So we're coming off highs a little bit. It's still a very decent day as cross price. Big rally overnight. U.S. assets, including Chinese assets in the U.S. We're continuing to see an extension of that, particularly when you look at some of these tech names, although I have to nuance that because we are coming off highs of the day. JD.com might actually be below water as I speak. But that said, of course, it's still a very decent day. Meituan. In case you missed that report coming out of Thailand, the company was given the permission nationwide to be able to bring you the goods using drones. Alibaba coming up on your screens as well, a pullback across some of the gold plays, Zijin and Shandong, as gold prices pull back. Xiaomi's bottom of your screens, 4%. Certainly Xiaomi and the story around cars and plans and it's certainly the backdrop there is the unfortunate accident about a week or so back. Might that be filtering into conversations? And we'll get more on this, of course, out of the Shanghai Auto Show with Stephen Engle, of course, our man on the ground there in Shanghai. Now, speaking of gold, just to pivot back to the precious metal and really the haven space. So a massive reversal higher today we're seeing in the U.S. dollar. The weakness coming through, as expected, are in the currencies that seem to be exhibiting overbought signals. So 48 hours back, the Swiss franc, the Danish krona, you have the euro, you have the yen as a good example. Asia, outside of China, and really just a good snapshot, really, of markets at this point in time. And dare I say, markets are less terrified at this point in time. 1.3% now is the rally we're seeing on S&P futures. Coming up this hour on the China Show, with lots of good conversations coming up out of the Shanghai Auto Show. James Peng, out of Pony.ai, the CEO, will be talking to us, of course, about the company focuses on robo-taxi business on the mainland and separately, but still on China and Chinese tech. The conversations around JD.com and Meituan and the back and forth between the companies. Chelsey Tam out of Morningstar will be joining us at the bottom of this hour. Avril.
Yeah, David, speaking of back and forth, some form of back and forth that we've really been seeing is Trump when it comes to targeting the Fed chair. And he's since saying that he has no intention of firing Chair Jerome Powell. And despite his frustration with the central bank not moving faster to cut interest rates, and the president had lashed out against Powell last week, posting online that his termination could not come fast enough.
The only thing that hasn't come down, but it hasn't gone up much, are interest rates, and we think the Fed should lower the rate. We think that it's a perfect time to lower the rate, and would like to see our chairman be early or on time as opposed to late. Late's not good.
Mr. President,
I don't want to talk about that because I have no intention of firing him.
For more on how markets are reacting to President Trump backtracking on criticism of the Fed chair, let's bring in our MLife strategist, Mark Cranfield. So we're seeing him doubling down, tripling down, and then walking things back. The damage, is it, something that is more permanent? When you look at how markets are reacting, how sustainable is all this rebound or reversal?
Yeah, when our heads stop spinning, then we'll figure out what it really means. But yeah, I think for long-term investors, I think they've seen a lot of damage done here. A lot of credibility has been lost. And if you're an investor particularly if you're running multi-asset portfolios, so much about what you do is investing in assets with credibility. And so much of what we've seen over the past few months is denting the long-term credibility, particularly of US-related assets, whether it's the US dollar, the equity market, the bonds, all of those things coming together, particularly the Treasury curve. Investors get very unnerved when supposedly the benchmark yield curve of the world, which is meant to be stable, is supposed to be the thing which other things are priced off, it's supposed to be a haven in terms of distress, is not performing its function. In fact, it's adding to the volatility in financial markets. That's a very unnerving situation for people who for many years have relied on that as being the one thing they could say, okay, that's going to be safe when everything else is shifting around. It's no longer the case. It's just part of the general flux of the markets. So if you put all those things together and if you look at the way in which the independence of the Federal Reserve has been questioned as well, although Mr. Trump may have dialed back some of his comments, he still isn't going outright and saying, I support an independent Federal Reserve, which is what international investors are looking for. That hasn't been the case yet. So yes, some of the sound bites sound a bit better than they did a few days ago, but we'll probably get more sound bites in the next couple of days. Investors want details. They want to see trade deals being done. It's all very well talking with various countries and saying that deals may be coming. They would like to see some. As far as they're concerned, what they have on the table now is they have a trade war that appears to be open-ended. They have lots of discussion in the marketplace without any real concrete details. Nothing is really giving them long-term confidence in US markets.
Yeah, Mark, so how long do you suspect the short-term bounce in dollar assets can continue? I mean, is headline risk as pronounced today as it's been all week, last week, the week before last week?
Headline risk is going to be with us for a very long time until we start to see some concrete measures which tell us, for example, is America doing a trade deal with Japan and on what terms? Is there going to be a trade deal with South Korea? And here's the details. Is there going to be one with the European Union? Until we get specifics on who the trade deals are going to be with and on what tariff terms, people will be assuming the worst. I know the IMF tends to be a little bit late in the game, but for once, IMF forecasts actually carry some weight because they're one of the first people to give a detailed outlook of where they expect the world to go in the months ahead, and it's not good. They're actually projecting that global growth will be the worst this year since the pandemic. That is not an invitation for investors to put a lot of money to work, to add a lot of risk. That's a reason to be cautious. So all the things that were making them cautious in the past few weeks look as though they're going to stay in place for some time until they are reassured concretely that something has changed positively. That's not the case yet.
So we want to see trade deals being done. Amid all this, we are headline surfing, whether it's from Trump or Besson on China. So that kind of muddies the outlook, or does it not, for the Chinese yuan, given the signals that we're getting from the likes of the PBOC?
It's one of the few consistencies that we've seen this year is the central bank in China are resolute with the yuan. They're gradually weakening it through the daily fixing. They're ignoring all the day-to-day noise. They're looking through the sound bites, and they know that a trade deal is not imminent with the United States, and they know that they need to protect their exporters with a slightly weaker yuan. The volatility is relatively low. That's a good thing. But you can see very clearly, just incrementally, the yuan is going slightly weaker, regardless of what's happening in the rest of the world. They've done it again today. They set the fixing above 7.21 for dollar yuan, even though they could well have set it a little bit lower than that. They didn't do that. They're keeping volatility down, but their messaging is extremely clear to everybody. The yuan is part of the negotiations, and we can use it as and when we need to. Mr. Besson did offer some sound bites which sounded good, but there was nothing there to suggest when a trade deal will be coming, on what terms. And so far, we don't have a date for President Xi and President Trump to meet, which would be a good indication that a deal is nearby. Until investors see that, they're not really going to be excited. But on the flip side, what you can see is happening. China is supporting its domestic markets pretty well. Chinese equities aren't behaving too badly. And if you look at the MSCI indices, which reflect more what happens in China and Hong Kong, you can see it's widening. So clearly, people are saying that on the ground in China, there is a chance for Chinese stocks which are domestically focused. Even though the rest of the world may be in disarray, at least support for Chinese entities is working.
Mark, fantastic. Mark Cranfield there out of our MLive team. MLive, you go, of course, for our Bloomberg clients on your Bloomberg terminal. Now, just ahead here, so we'll talk more about Donald Trump and those comments and how he actually said it, which is, I guess, in some ways, perhaps a more helpful exercise, the context there, and how he said he promises to play nice with China and predicting that the final number will be lower than the current level of 145%. Plus, we'll have a look at some of the trade flows coming through here in Hong Kong across the Stock Connect as an indication of how much lasting power this rally actually has. This is the China Show.
We're going to be very nice. They're going to be very nice. And we'll see what happens. But ultimately, they have to make a deal. 145% is very high, and it won't be that high. I think we'll make a deal with China.
That was President Trump on how the White House is still open to a deal with China. Playing nice is how he framed it today. Let's bring in Min Min Lo, our China correspondent, just to help us understand the prospects of a deal. And I guess it's important to also know the question that he was asked. For him to be able to phrase it that way.
He was asked whether he will play hardball with China, and he said no. And he also says that the tariffs are going to come down. It's not going to be anywhere near 145%, but it's also not going to be zero. He says China is going to be very happy with the deal. But again, it's a lot of talk and no action for now. We have Treasury Secretary Scott Bessent also reassuring markets in a closed-door event, an investor summit hosted by JP Morgan Chase, saying that this standoff is too unsustainable sustainable, and both sides will have to find a way to de-escalate, quote, at the very near future. But he also cautioned that any sort of big comprehensive deal is going to take 2 to 3 years to materialize. So it seems like perhaps the pain in markets and in the economy is perhaps too high now, and the administration is at least seeing a little bit more urgency to tout some of the progress that they are making with some of these bilateral trade deals. But again, with President Trump being so mercurial and changing, eating some of his words just, from day to day, it really begs the question of whether this is just a throwaway comment or a move to shore up market confidence, or if it is really a meaningful shift in his stance on China.
So how is China likely to respond amid all this, Min Min?
Yeah, as I said earlier, it's been a lot of sound bites, but not a lot of action. So there are a few ways this could go. One is perhaps China take this as an opening to reach out to the U.S. without losing face. That's one way. But the other way this could go is it just, weakens the credibility of Trump even more. And China is a country that really pays attention to sincerity when it comes to these talks and deals. And the question is whether China will still wait for the U.S. to be the one to reach out to them. Who's going to get the ball rolling? That's the question. But of course, earlier today, we already got the first indication from the fix, which was set slightly higher, as Mark Cranfield was saying they could have set it lower, but they didn't. It shows that the central bank thinks that it's still too early to let the yuan strengthen, despite some of the soothing comments from Trump and Besson. So, well, how this is going to go down is really anyone's guess at this point.
Yeah, well, we'll see. We'll see what happens tomorrow morning. Things, of course, do tend to change at a lot more frequent cadence than we're used to. But yeah, it's news and it gives us reason to exist, doesn't it? Okay, Min Min Lo, our China correspondent there. Right, let's talk about Tesla out with earnings after the market. It seems investors are liking this one, looking at the after-hour session there, which ended about, let's say, 2 hours back. 5% to the upside, although when you look at the numbers, doesn't seem to indicate why markets were cheering this one on. Well, why do we get a sense, really, of why things are so? Rachel Chang is with us here, Bloomberg's Asia Global Business Managing Editor. There we go. I got something right for once. Rachel, yeah, just square the circle for us. Why are investors cheering this one on?
Right. I mean, it is weird because earnings is not very positive. Both sales and profit was below expectations, and the company dropped, what they earlier said, which is that the company would return to growth this year. They pulled that forecast essentially. So not that great. But what investors are really happy about is Elon Musk essentially putting a date on the fact that starting next month he's going to pull back from his work with the Trump government and return to focus more on the company. I think people have been worried for quite some time that there's nobody at the helm of Tesla essentially, because he's been so wrapped up with his political work. And, the company is at a major crossroads, right? It's facing really intense competition from these Chinese competitors, BYD really surging all over the world. And the fact that they're so delayed on a lot of those major launches, they do need that more affordable car to launch in the first half of this year, as they've been promising for a long time. Investors really want to see that company return to growth, and they're taking it as a positive sign that he's gotten the message.
So to what extent is his sort of pullback in DOGE likely to help, solve some of the issues related to Tesla, whether it's branding or renewing its lineup? How do we see that moving the needle then?
Right. I mean, there's been a lot of attention on the negative political press that Tesla has gotten because of Elon Musk's role at DOGE. All of those protests setting Teslas on fire. We do see sales dropping a little bit in Europe and Canada. But, those are really on the margins, and there's really core business problems that Tesla is facing that you do need a fully focused CEO to address. Like I've mentioned, BYD surging. These Chinese EVs are just so affordable and so high performing, and they are taking over the world outside of the U.S. Is Tesla ready for that competition? About a couple of years ago, they gave us the impression that yes, they are ready to take on that competition with more affordable models that they're going to be launching for sort of that lower price point consumer They are still delayed on that. He's reiterated the promise that those models will come in the first half of this year. And essentially, I think people just want to see leadership at the helm of this car maker, which had such a huge, hold on the culture for so long. But it's a different state now in the EV industry. And will Tesla continue to be a player in this new environment of affordable EVs for the masses? That is a question that only a proper leader, fully focused on the company, can answer. And I think that's what people are hoping for, really, with his return.
Fantastic context. Rachel, thank you so much for that. Rachel Chang there, our Bloomberg Asia's global business managing editor. Certainly a stock to watch as you approach the Wednesday open in the United States here. We are likely going to see a pop. Shares of Tesla, I'm seeing so far just two houses coming out with their latest calls post-earnings. A hold at Mirai, and out of Daiwa, a neutral recommendation there, so not exactly a bullish call. We'll see what the rest of the day does hold for us. Right, coming up next, we're staying on cars, and we'll be live at the Shanghai Auto Show, speaking exclusively with the co-founder and CEO of Pony.ai. This is Bloomberg. Right, welcome back. You're watching the China Show from here in Hong Kong. We'll take you straight back to Shanghai, where the auto show is taking place. Stephen Engle, our Chief North Asia correspondent, is there with his next guest. Steve.
Yeah, let's talk further about AI and autonomy. Obviously, key elements to the future and the present, actually, of the automobile industry. And this is a good test bed here in China for these technologies. Let's bring in our next guest. He's James Peng, Pony.ai founder and CEO. Good to talk to you again.
Yeah, Steve, it's great to see you again.
Okay, so a lot has happened in the last year. There's a trade war. There's been regulation from the MIIT of basically slowing down, trying to take a little bit more of a scrutiny of autonomous driving. Lots has changed. What are you here at this event to announce?
Yes. As Steve, you mentioned, there's a lot has changed over the last year. But internally, we have seen the steady growth of our autonomous driving development. At this event, we are unveiling our next generation robotaxi, and which will actually be equipped on 3 vehicles. There are Toyota, there's a GAC Aion, and there will be a BAIC Arcfox. So the 3 models, same platform, and it will be actually be mass-produced toward the end of the year.
So this is the 7th generation robotaxi. Last year you had trial taxi services in Beijing and in Guangzhou with Volkswagen, your partner. So now you have 3 different ones. You still have Toyota, Arcfox, and of course Aion of GAC. So what is different this time? Is it more LiDAR, more vision, more sensors? What?
No, I think there are actually 3 highlights of our 7th generation. The first one is it's a fully autonomous grade, meaning all the components, including the computer, including sensors, are autonomous grade. That means they can last for 600,000 kilometers, almost 10 years, designed life expectancy. The second is the cost. Cost is essential. The cost of everything is, compared with the last generation, the 6th generation, is 70% lower. That means we are in the process already for large-scale mass production. And the third highlight is it's an integrated platform. As you can see in our booth, we have unveiled the same setup on 3 vehicles. That means it's exactly the same platform.
How are you mostly acutely affected by the trade war that is happening right now? Because you founded in Silicon Valley. You had test zones there as well in Silicon Valley. You're kind of a Chinese and American company. But I understand you've said you're going to focus on China now, primarily.
Yeah, I think from the launch markets, we're a bit affected. As of now, I think China has the strong demand from the users, has strong support from the regulatory front. That's why we're focusing in China market for now. Although we definitely have some international markets expansion as well in South Korea, in Luxembourg, in the Middle East, Singapore and whatnot. I think the trade war, in terms of the components and the computer chips, we're actually not really that much affected because we have different sourcing across the globe.
How is it different, though?
Because most of the components are not really manufactured in the U.S. per se. They're actually all through the global, and we're trying to have different suppliers and partners on different markets so that we can have insured supply chain.
How has the overall trade friction, though, impacted your ability to sign new partners and new customers, new automobiles that want to use your technology?
I think the effect is rather limited. I mean, the effect is not really that big for us because we are focusing on the non-U.S. market for now. That means we're currently not working with the U.S. car manufacturers. And we're expanding into other markets. As Steve, you mentioned, I think the trade war will affect us maybe in the long run, but at present, I think our business, our R&D, our development are really not affected.
What's your next priority market to go into?
I think it's Southeast Asia, East Asia probably more, Japan, South Korea, and Europe, and the Middle East. Those are the three main regions.
The Ministry of Industry and Information Technology out with new guidelines and regulations to kind of increase scrutiny on autonomy and self-driving. They don't want car makers to call it self-driving. They want driver assistance because, again, there was the Xiaomi fatal crash, which kind of raised the safety issue. How is that going to impact you with your robo-taxi services and fleets?
I think, in a way, it's make the distinction between driver assistance system and fully driverless more clearer, because we are really developing fully driverless, and the fully driverless means the car's safety is responsible by the vehicle itself, whereas driver assistance system is still the driver's responsibility. I think because of the current regulation or the current requirements, it's actually pretty make us easier to stipulate the distinctions.
Yeah, but it has. Would you feel that some automakers, in the rush to gain market share and also gain eyeballs and clicks, they've really kind of hyped up their own versions of autonomy, right? Every car maker seems to have their own one, but it seems like because of that Xiaomi crash, the regulators now stepping in and saying, we need to rein this in. Does this slow the adoption and the development of autonomy? Because even Tesla, they want full self-driving in China, but they've been slowed. The MIIT has said you can't call it full self-driving.
Yeah, but in effect, they are not full self-driving. I think by having this to be clearer, it's safety first. For any autonomous driving, either it's a driver assist or fully driverless, I think safety is always the most critical one. I think having some restriction on what the manufacturers can claim, probably in the long run, is better for the consumers.
Does it limit your ability to expand your pilot zones where you are providing actual real-time service?
No, I don't think it's going to limit our services, but I think it will make our claims to be clearer.
Yeah. What about some of the other products, eVTOLs and other products that your technology can go into, and what are you marketing? Who are you marketing to for those services?
Yeah, because along our development over the last 8 years, we have developed many different products, such as you mentioned is really the domain controller, the computer within the vehicle. And because we have accumulated extensive experience on the manufacturing of those components, we actually support to the eToro and also some of the last mile delivery vehicles, and to enable our partners.
Yeah. So you're in the 7th generation of the robo-taxi. How much evolution have we seen from when we talked in this same place last year at the auto show in Beijing till now? So there's much more sensors, many more cameras, and the level. What level are we at now? Level 3 and
level
beyond.
4.
You're level 4.
Level 4.
Yeah.
It's fully driverless, and I think compared with last generation, the supply chain is quickly maturing. So it's not the number of sensors, but rather the cost and the quality of those sensors is improved dramatically. And also the computer chips. We're now using the auto-grade computer chips. So overall, makes the vehicle to be much more integrated, much cheaper, as I said, 70% cost reduction. And also it's ready for, and actually it's much more integrated, so it's ready for large-scale manufacturing.
Where do you stand with your own chips and your procurement of those auto-grade chips? Because NVIDIA has Orin and Thor. I've talked to a number of car makers like XPeng and others. They are going in-house with their chip development because they don't want to necessarily rely on a foreign chip, even though those are not necessarily under export control. But as the U.S.-China relationship bifurcates potentially further, do you have a vulnerability there?
No, I think there's some domestic chip manufacturers going into the computer chips for vehicles. So I think for now, we're using the Orin and of course the next generation, which is Thor. But we have some domestic alternatives.
Yeah. So by the end of this year, how many robo-taxis with your brand on it is going to be all across China?
Definitely will be more than 1,000.
More than 1,000, right. Yeah. James Peng, so good to talk to you. Always good to get an update on Pony.ai. Okay.
It's great to talk to you, Steve.
Yeah, it's great to see you. Always love talking about AI and autonomy here at the China Auto Show. Back to you guys.
And we love hearing those great conversations. Thanks so much for that. Our Chief North Asia correspondent, Stephen Engle in Shanghai for us. And you can also turn to your Bloomberg. For more on this, go to TLive Go to get commentary and analysis from Bloomberg's expert editors. Dave?
Yeah, let's turn now to the non-expert, but yeah, I'm just going to tell you what's happening anyway. Observations across these markets. Very good session so far. We're about an hour into the cash market session here in Hong Kong. And, you know, since the open here in Hong Kong, an additional leg higher on the Asia-Pacific index, which was already doing quite well because of the Taiwan Open. But, yeah, we're now up 1.4. Similar move higher in S&P futures. Tesla, obviously, is a stock to watch as you go into the Open today. What's interesting, though, is the pickup in the U.S. dollar, right? So it's not too visible on your screens, but the massive reversal after the dollar entered really extremely oversold, short-term oversold conditions against some of the majors. So the Swiss franc is on the back foot, the Japanese yen, Danish krona, euro among the top four to the downside. Every single sector, as you can see, is up. Asia dollar index is obviously the mirror opposite of what you're seeing across the U.S. dollar is concerned. Right. So the other thing that we also observed yesterday, and we'll juxtapose that with what we're seeing so far today, is you had a massive amount of money coming through the Stock Connect on Tuesday. So net buyers, and it's worth pointing out, of course, we're coming off a long weekend. So Friday and Monday, markets were shut, so there wasn't obviously pent-up money waiting on the sidelines. And then we are getting a pullback today. So far, mainland investors have been net sellers of Hong Kong stocks so far about 62 minutes into the session. Right, let's just very, very briefly, let's have a look at some of the news across e-commerce stocks as well. So on the left, you have the price action on Meituan, JD, and Alibaba. So we've been all over the place in the sense that we opened massively higher on Baba, 6%. We pulled back to about 3 and 4 and have since seen a little bit of upside. JD.com almost reversed completely. The gains were now up about 0.5%. So a couple of news to tell you about today. So you have Alibaba and PDD halting refunds with no return. So effectively, what our colleague Catherine Lim out of Bloomberg Intelligence was pointing out, this will effectively make it cheaper for both these companies to deal with refunds, which is a good thing for both, I guess, in some ways, both the companies longer term. JD.com, and we've been talking about this other story all week, which led to, by the way, the big drop in shares yesterday on Meituan and JD.com. I think Macquarie came out and then downgraded the stocks on their call there. Increased competition, this back and forth you have on social media. It's now really called attention to JD.com and its food delivery service, and might that actually tempt other buyers who may not have been aware that it actually existed to try it out. No press is bad press, as they say. Yeah, and apart from that, if you're somehow living in a more inaccessible area, you might get a drone coming to you. Thailand reporting that Meituan is now has been given the permission to use drones, delivery drones, nationwide. Okay, let's zero in on this turf war between JD.com and Meituan. And let's bring in Chelsey Tam. She's senior equity analyst at Morningstar. Very nice to see you, and good morning. So I'm sure you've been following the back and forth on social media. Why don't we start on JD.com? What do you think they're doing, and what do you think the short-term impact will be on the business?
Sure. So they have this public dispute between JD and Meituan. So I think in the short term, there would always be some customers, some merchants, some riders that might agree with what JD said. So they will check out the JD platform, and they might join the platform. So I think that's the maybe impact in the near term. In the longer term, I think that JD might not be willing to invest consistently in high level of subsidies to jeopardize their earnings and margins. This is because if we looked at the previous internet battles in community group purchases, for example, or in Jingxi business, they weren't really super all in terms of investment, and I think that they really care about maintaining the margins. So I feel like in the longer term they will probably not invest so much, which means that Meituan position will be quite stable in the longer term.
Right. That's a good observation. JD doesn't usually like to sacrifice margin, right?
Yeah.
Does that then, I mean, is this a specific business that needs investment? In other words, without sacrificing margin, do they make inroads enough that it affects the overall business, the overall revenues of JD.com?
Yeah, that's a very good question. So Meituan right now has a narrow mode rating, so that's a Morningstar methodology.
Okay.
So we think that it has network effect, which is three-sided: riders, number of merchants, and number of consumers. And then they have give or take 70% market share. So in order to build that network, they actually spend so much money subsidizing and then doing a lot of on-the-ground operational work to recruit merchants. So it involves a lot of investment. So unless JD wants to do all of this over again, I think it will be quite hard, especially unlike Douyin, where you can do short-form videos, you can do live streaming. That's the main capabilities. They have something different to offer. In JD, the things that they can offer compared to Meituan is not exactly the same.
Okay.
So it's the things that JD and Meituan, the things that they can offer are quite similar. I'm sorry. So, but then for Douyin, it's different. It's impulse purchase, different format. So I think in that case, it's harder for JD to really break into this market big time.
So it sounds like, Chelsey, for the foreseeable future, Meituan is going to continue have that sizable market share. Overall, what does this mean for the outlook and some of these ratings that you have for both Meituan and JD?
Yeah, thanks for that question. So I think Meituan and JD, they're actually both undervalued right now. So both of them are multi-companies in our view. We think that there will be some margin decline for Meituan in the longer term just because of competition. I think JD will not be the last one to enter the food delivery markets. So then we assume some kind of margin decline, but then overall we believe that it will be able to maintain its market position in on-demand delivery, not just for food delivery, but also for on-demand retail, which means, buying medicine on demand, things like that. And then for JD, we think that right now it's really benefiting from the trade-in subsidy program. And then they still have this really unrivaled long-distance, very quick delivery. They are they have this first party where the reputation is good. People trust the quality. And then they have this 211, a very quick delivery program. I think if you look at for example, another way to look at the valuation, JD is now high single digit, give or take maybe around 8 times PE forward in the forward basis. Meituan is about 17. So they're both at very low levels because of this, I think this like turf war, and also because of like generally weaker sentiment in Chinese stocks because of the tariff war. So I think these actually present pretty good opportunities to buy these two companies.
And since you raised the trade-in subsidy program, what is your sense of the timeline for stimulus? Because in China, it does feel like they're still biding their time in terms of more forceful measures. But how long do we have to wait for that to come through on the fiscal front, potentially, maybe handouts, subsidies, and then helping to re-accelerate growth for some of these Chinese names?
Yeah, so I think that, as you mentioned, and I believe that's what the market also believes, is that the government will take their time. So they will probably observe what is the pain from the export community. They will support the export community, I believe. They will try to ship some of these products to the rest of the world. For example, Europe, Latin America, Southeast Asia. And then if like some of these measures don't work as well as they do, I think they will try to, obviously, they will also sell within China. And then if like unemployment or things like that get really bad, then I think they will roll out more stimulus. They could broaden the trade-in subsidies, for example, to cover like smaller, even smaller electronics or to different categories. They can subsidize childbirth. There are actually a lot of interesting local government subsidy programs or support programs that are already in place nationwide. So I think that these are something that we will expect to see. And then for the trade-in program, it doesn't have to be just 1 to 2 years. I think that like right now, my base case is that it will at least 3 years. And then with the trade war, you can add 1 or 2 more years to it. And then you can also expand the amount of subsidy. So for, I think actually the subsidy level has already doubled compared to the year ago period.
And Chelsey, I guess just to understand then how the subsidy program works from a sort of whose margin gets hit along that value chain. So these are the platforms, and then you have obviously the vendors, right? So if we talk about and extrapolate subsidies being extended, say for a couple of more years, does that hit mostly the vendors, or is there something that gets passed through the platforms like JD.com and Meituan?
Yeah, so luckily in this case, the government is doing like the heavy lifting. They're providing the subsidy with the ultra-long bond program, like the money that they raise from there. Yep. But then you're right that there is still some kind of subsidies. For example, like there might be some subsidy from the vendors or the platforms to drive other categories that are not covered in the national trade-in subsidy program. So that way they will drive more cross-selling and GMV.
Right, and it's cheaper for everyone. Let's put it that way. So it's a good thing. So I think earnings are coming up for both. I don't think we have a specific date yet. Let's call it mid-May. Anything else you think we should be watching for both?
Well, I think that obviously for Meituan, you would want to see what they talk about, like the competition in food delivery. For Meituan, like the margin impact, and then. Actually, very important to know if they're really expanding to like the rest of like Middle East, and also like there are some talks that they will expand there and also expand in Brazil. And what is the investment? So that would really reduce the margin, for example. And then I think that other than food delivery and the new businesses, I think instant shopping is still interesting to watch. They have turned positive in the unit economics, so it'll be interesting to see how it goes. If it's AOV, which is average order value as a whole, increasing, which means like it's better. Like the consumer sentiment is it getting better? And then for JD.com, obviously all eyes on like the not just like the competition, how much it will drag margins, and also on how like they're doing in the subsidy categories, which is like the home appliances and smartphones. So we'd like to really see a growth there, and also how it will actually benefit the general merchandise. Because one of the stories is that not just that the categories that are being subsidized see very, very good growth, they actually see broad-based growth in different categories. So I think that's something to watch, and whether they want to revise down their margins.
Fantastic. Chelsey, thank you so much. That was great. Great insights there out of Chelsey Tam, Senior Equity Analyst at Morningstar. Right, if you're one of our subscribers, you can catch that specific conversation we just had there with Chelsey. Interactive TV function. Scroll back a little bit to get that, and scroll back a little bit more to get others from this morning. Lots more coming up through here on the China Show. We're about an hour and 15 minutes into the cash market session, and we're still higher across most of the benchmarks in the region. It's a good day to be long these markets. Good morning. You're watching the China Show. Welcome back. You're watching the China Show. So the IMF has cut its global growth forecast here for this year and also for next year, really citing risks from this ongoing global trade war. We spoke with the MD, and she told us that the chances of the global recession will rise if uncertainty over tariff policies drags on. President Georgieva also spoke to us at the sidelines of the IMF's annual spring meetings taking place in Washington.
Trade is an engine for growth. And what we see these days is that when trade goes backwards or slows down, that has implications for global growth. As you know, we just projected the growth expectations for 2025. We are downgrading by 0.5 percentage point from 3.3 to 2.8%. Our forecast for the world, we are downgrading our forecast for almost all countries, including the United States, as a result of trade tensions.
Yeah, one thing that in that world economic outlook, you put the chance of recession in the United States up to about 40% from 27% back in January when you first published it. If the tariffs stay as they have been proposed from the United States, do you expect that chance to go up materially?
This is based on the announcements of tariffs that have been then suspended, but not for China. So it's a complicated story. The short answer is that we are operating at a time of very high uncertainty. If we see faster resolution of trade tensions, that would possibly lift up projections for global growth, great for investors, great for families. If, however, we do not succeed and uncertainty remains very high, tariff problems hang on our head for much longer, then we actually can see even further reduction in global growth, and then the danger of recession looms bigger. What is our advice? Please talk with each other, find a way to resolve differences, and above all, reduce uncertainty. Uncertainty is bad for business.
And I think a lot of people have raised that issue. There has been speculation, including by this administration, that the United States could potentially even withdraw from the IMF. Do you see that as likely or possible? Do you have contingency plans for that?
We have very good relations with the United States. We have traditionally worked very closely with each and every U.S. administration. We have now established relations with this administration. The United States is carrying out reviews of its participation in international organizations. This is very fair. They have the right as a member to look into the mirror and say, do we have value from participation at the IMF? And I can tell you, I'm convinced that they look at this and they say, yes. Why? First, we are the only institution that can rescue countries in trouble. There are many countries that the U.S. cares about, that the fund is there to help them in a moment of high trouble. Two, we are the only financial institution, Lisa, that is like a savings bank. The U.S. puts money, we lend, then we give it back to the US with interest. The last 2 years, we have paid $3.1 billion in interest to the United States. So, you know, the concern is, are taxpayers of the United States paying? In the case of the fund, no. And 3, we are promoting things that the US cares deeply about. Private sector-led growth, discipline, transparency, accountability. And I think for all these reasons, and also let me not forget, where are we? We are sitting with you 2 blocks from the White House. I think that the outcome of this review for the IMF would be, yes, great institution, we stay.
IMF Managing Director Kristalina Georgieva with us there. Plenty more ahead. This is Bloomberg.
Really strong bid across the crypto complex. The reason I frame it crypto complex, you obviously have the cryptocurrencies. Bottom of your screen is Bitcoin. 93,000 now, in case you missed that. Check out the daily chart on that going back yesterday. And it's also playing out across the equity complex. This relief rally across really some of the beaten down names because of the pullback we've seen in the likes of Bitcoin. Right, let's just change the pages very, very quickly here. Drug producers in China, as you can see here, the Morgan Stanley does see, out with a note here, does see a limited business impact as far as some of the levies go here. Tariff exposure no more than 10% across the sector as far as direct tariff exposure is concerned. And some of the Apple suppliers, as you can see there, as Donald Trump, the U.S. president, dials back the rhetoric and the hard stance there from recent days as far as the playing nice and wanting to do a deal with the Chinese, a relief rally of sorts across the region. Want to watch this very quickly before I go and toss it back to Avril here. So the HIBOR fixing, which comes out 15 minutes after the next hour on a daily basis, we're looking at CNH, not HKD. Record low yesterday, so effectively it's very easy to get access to renminbi in the offshore market. Do we see a further drop in funding costs, which, by the way, makes it effectively cheaper to short the currency, but we are on weaker footing as far as the basket goes. So, yeah, Avril, lots to watch there. What are you watching at this point, Avril?
Yeah, I mean, as you say, right, cheaper to source renminbi. We're seeing dollar China sitting above the 730 handle despite this optimism about trade tensions easing between the U.S. and China. It's really the signals we're getting from the PBOC. Hang Seng, potentially a 3rd day of gains. And that is it for the China Show. Insight is next. We'll see you tomorrow. Stay with Bloomberg.